What's up, everybody? Welcome to this week's edition of our weekly coaching webinar. So today I want to talk about something different. I want to talk about PPP loan forgiveness, and here's why. Because about a week ago, the Treasury released their guidelines on loans forgiveness for PPP loans, really changing what we believed would be the case on how these loans may be forgiven, if they'll be forgiven, how much will be forgiven. And as this is changing in real time, I think that you and I have a huge advantage of being first out there with this kind of information. So when this happens, I typically within about a week am releasing the information about what the changes are, and this even includes information about future changes. So I'm going to make sure that this PowerPoint is available with this webinar as a download in case you want to do the same thing. You may want to use this PowerPoint for your own business. Obviously, you can see our phone number at the bottom. You can see our link. There's obviously some things you're going to want to change on the webinar to make it yours. But again, we just prepared this yesterday, and we're getting ready to do this Thursday as a release. So I wanted to go over this with you for, 3, 4, 5 different reasons. One of which is I want you to have this PowerPoint in your hands in case you want to educate your audience and be the first out to start talking about PPP forgiveness. I've seen in this space that the conversation has changed from getting a PPP loan to PPP loan forgiveness. As more and more people are now successfully getting their PPP loans, now it really goes and the interest kind of shifts to forgiveness and what can be forgiven, what can't be forgiven. So this is the topic of the moment per se, where everybody wants to know about this. The second reason I wanted to do this is I want you to know the information. A lot of you on here have got PPP loans yourself or about to, and you need to know what's going on because this is changing in real time. And it really is the difference between if this loan's going to be paid back or not be paid back. And the terms of what might need to be paid back and not be paid back, even the terms are going to change from what they originally told us. So you need to know that information for yourself. And the third reason is you need to know this information for your customers. If you're going to be offering business credit financing and you're going to be in the financing space, then PPP loans are what all is the rage right now. It's what everybody's talking about. So you need to be educated yourself. So we just literally created the content for this yesterday. The graphics and stuff were done today. And when I thought about the webinar, I thought, man, I'm just going to go over this with everybody so you know about it for your own interest, so you know about it for your clients and can answer questions, and so you have access to the PowerPoint if you want to turn around and educate others of how this works, even use it as a way to drive in new business for yourself. I figured you can't lose. So let's dive in. Let's jump into it. So you guys already know about the PPP program. Not going to talk a lot about that. The basic requirements were if you were in business before February 15, 2020, you have less than 500 employees and have at least one employee that you could qualify for this. And again, as we saw in the beginning, almost every entity could qualify: sole props, independent contractors, self-employed, corporations, LLCs. That just didn't matter. Anybody can get it, for profit, even nonprofit, even churches were able to get this that were excluded from that EIDL loan. So I'm not going to spend a lot of time on that. But on May 22nd, we actually saw the Treasury Department issue the interim financial rules on PPP loans. So the Treasury Department's now actually come in and they're really setting up what needs to be known about getting the loan actually forgiven. Now, this is pretty complicated. As a matter of fact, with everything with the Treasury Department, the level of complexity and complications to us is pretty significant. That's where the House and the Senate are going to come through and probably rule on their own forgiveness loan that will trump some of what we see here, that will give us some clarity, whereas even the Treasury Department's interim rules, we're just not that clear. So a lot of these things are difficult and a lot of these things are different. I mean, first of all, calculating the forgivable portion is far from intuitive. Okay, it's, as a matter of fact, I think it's described by Forbes that you need to have an accountant, an attorney, and somebody else, I forgot who they mentioned, to even be able to figure out how much is going to be forgiven. It's not simple. It's pretty complicated. And the new Treasury regulations are going to leave a lot of business owners potentially in debt when they didn't think they were. They thought this loan was going to be forgiven, and a lot of it's not going to be forgiven potentially. And the problem with that is it also leaves lenders with short-term 1% interest rate loans that they can't make any money on, and that's really not in the spirit of the bill. Okay, so what happened was this bill was passed, quickly, and the money was dispersed quickly to help everybody in a time where we needed it quickly. And now, as everything's getting sorted out, the Treasury Department's coming in and making some moves that kind of goes against the spirit of the original bill and could possibly create a lot of what was believing to be forgiven not to be forgiven, and banks doing short-term loans with 1% interest rates, which they make no money on and have no interest of doing whatsoever to begin with, right? I mean, what they're planning on doing is getting that loan forgiven and getting it paid back by SBA. And if that doesn't happen, then it creates a lot of issues for everybody. And that's why the Treasury and the House and the Senate will eventually vote themselves on a new PPP bill, because what's going to happen there is that you're going to find a lot of people or a lot of people are not going to want this outcome. They're not going to want banks holding the short-term loans. They're not going to want business owners thinking that they got a loan forgiven and not forgiven. So that's why eventually I think that they're going to make some corrections here. So first, one of the changes that you should know is that the SBA can review any loan at any time. So what happens now is all loans under $2 million basically are susceptible to this. And if you look at the PPP loans, almost all of them are less than $2 million. I mean, the vast majority of them are. So that being said, that means almost all these PPP loans are in this where they can actually be reviewed at any single time. It's called safe harbor. Okay, so the May 13th Treasury FAQs provided a safe harbor for all loans under $2 million, deeming them made in good faith and that the economic uncertainty faced by the borrower necessitated the loan. But it did leave open the possibility that SBA could review all loans to determine eligibility and accurate calculations for the loan amount forgiveness. So what they're saying is this, and this is what happened. They basically, SBA didn't review all these loans. They gave the banks the ability to do all the calculations of what was to be for what was to be issued loan wise based on the payroll of the business, right? So we know that a business got 2.5 times the amount of their average payroll. And then the banks were given those guidelines, and the banks were responsible for underwriting to determine how much money was to be lent to each business. And from that, then the loan never went through SBA. So this was new because all loans are typically underwritten by SBA and the bank both. But to expedite this, they took SBA out of the picture, and for obvious reasons, right? We understand that. I mean, if every loan application had to go through SBA and SBA didn't, 10x their staffing, they never could have processed it. It couldn't have happened fast enough. So they gave the ability here to have what's called a safe harbor for all loans under 2 million, which just meant, hey, if the loan was issued by the bank, like, you're safe. You don't have to worry about SBA ever coming back and re-looking at those calculations. But now what's happening is it's leaving this door open where SBA can review the loan at any time to determine eligibility and accurate calculations for the loan amount and forgiveness. So they can question the amount you were lent at any time. They can question the amount that's forgiven at any time. They can question whether you were even eligible at any time. So that safe harbor doesn't really exist. Now you kind of have the cloud over your head where any of this stuff can happen at any time. Now the regulation says for a PPP loan of any size, SBA may undertake a review at any time in SBA's discretion. For example, SBA may review a loan if the loan documentation submitted to SBA by the lender or any other information indicates that the borrower may be ineligible for a loan or may be ineligible to receive the loan amount or loan forgiveness amount claimed by the borrower. So bottom line is, you don't have that safe harbor. They can come in and SBA at any given time can actually review that loan and determine you weren't eligible. The loan amount was wrong. The amount forgiven was wrong. So this obviously creates a big sense of uncertainty, I think, with a lot of business owners. Now, under these rules, SBA can review the loan and determine you have credit elsewhere or other funds. So that was one of the other things that came up with this, is that they didn't want you to have credit available elsewhere to get the loan or other funding available. And that was common with the EIDL loan, and some of that carried initially onto the PPP loan. So what that means is, it means SBA at any time could look at your application, say, you could have got a loan elsewhere. You weren't even eligible to get this loan. The whole thing now needs to be given back to us, for example. So those are some of the issues that come from this. Now, they could require you to pay back the whole loan or part of the loan as a result of that. Okay. And as you can imagine, that would be a big problem, because the SBA can withhold the bank fee or call it back if they make that determination, and it creates serious issues with the banks, and it obviously creates a lot of issues with us as business owners as well. and at least the SBA will still guarantee these loans. So the bank's not going to be out. The bank will get their money, but again, they can make you give that money back because they deem it to be that you never were able to get the money to begin with. Okay. So also, let's talk about slow loan forgiveness. Once you file for forgiveness, then the bank has 60 days to review that. And the bank will notify SBA. Then the SBA has 90 days to approve the bank's decision. This is a big deal because when the PPP loan came out, the 60 days existed, the 90 didn't. What that meant is it meant that you have 6 months to pay back or before your first payment starts on the loan. That's how it works. So they came out and they said, look, PPP loan, for 6 months, it doesn't even you don't have to make a payment on it. Then they said every bank has 60 days to review it. Well, that makes sense. I mean, the bank had 2 months to review it, and you don't have to make your first payment for 6 months. Plenty of time for the bank to review it and to know what's forgiven and never have to make a payment on the loan. The problem is now is the SBA now has 90 days to approve the bank's decision. So if you look at this, it takes 5 months just for this. If you submitted the day, the first day you could, 60 days after it, or the minute you could pay the loan back, then let me add this up a different way. Let me do the math a different way. Okay. So with PPP loan, you had 8 weeks to pay back to use the money, right? 8 weeks to use it on payroll is what we were allowed. That's 2 months. Now the bank has 2 months to then verify, or to look at and approve your loan for forgiveness. Okay, we're at 4 months. But you see what happens with this 90 days. It pushes us to 7 months. The problem is that's a problem because we have 6 months without making the first payment. So, and again, even that was a gray area because then they initially wanted it to be a year. So the problem here becomes that your first payment on the loan could become due before it's even approved by the forgiveness is even approved by SBA. Okay, that's obviously a big issue. Now, for all this, SBA can request more information from the lender or borrower directly. So even after that time frame, 2 months bank review, 3 months for SBA to approve it, even after that, SBA can come back and still ask for more information. So it could even prolong the 3 months that SBA says that they need to actually review that loan. Okay, so that is a problem. And then they said, then they'll approve the amount in whole or in part. So some of it could be forgiven, none of it could be forgiven, all of it could be forgiven. They'll determine that only after they have up to 90 days to review it and request any other documentation they need. Now, if the SBA determines that a portion or all of the loan did not meet their guidelines for eligibility forgiveness, it can request for repayment of the loan or pursue other available remedies. So they can come after you for the money if they see that part of that money is not actually going to be forgiven. And the new Treasury Department guidelines do not explain what these other remedies might be. That's even scarier. So now the SBA can pursue other available remedies to get their money back from you with no description from the Treasury Department of other available remedies. Now, I don't like that at all. I don't like the Treasury Department having the ability at free will to pursue other remedies to get money from me. Okay, that's a little bit open-ended there. So you can see some problems there. And you at least do have a right. The Treasury Department did give you a right to appeal the decision if the SBA says some or none of it will be forgiven. But again, that would even add more time onto the forgiveness portion of it when you're trying to avoid making that first payment. You're just going to run out of time to make that first payment. So now the SBA requires borrowers to keep all the information on PPP loans on files for 6 years. This is brand new. We've never seen anything like this before. So if you get the PPP loan and you have all the documentation you used to then file for the SBA loan, and then I think somebody just showed up at my door, so don't mind the dogs in the background. And then on top of that, you then have to have all the information you're submitting for forgiveness on file for 6 years. So the bottom line is you need to make sure that all this information is on file for 6 years. And then, that means you could be audited for 6 years. Okay, so that gives you up to 6 years to actually get audited as well. Sorry about that. So that gives you up to 6 years then to actually potentially get audited, which creates even more of an issue. I mean, for 6 years, you have to worry about them SBA coming back at any time and questioning anything to do with your PPP loan, just uncertainty. So the regulation states, as noted on the loan forgiveness application form, the borrower must retain PPP documentation to file for 6 years after the due date the loan is forgiven or repaid in full, and permit authorized representatives of SBA, including representatives of its Office of Inspector General, to access such files upon request from the time of application. I don't know about you, but that scares me. The fact that I've got to keep all my records on file available for the SBA or IG to look at it anytime for 6 years after the loan was actually forgiven. So the borrower must make the forgiveness calculations on your own. You got to determine how much is to be forgiven, okay? You're responsible for calculating the forgiveness amount and providing the necessary documentation along with the forgiveness application. It's then the lender's responsibility to make a good faith review of that application before submitting it to SBA for their 90 days to review it. Now, the guidelines say a good faith review could include checking a payroll report from a third-party provider or just checking your canceled checks, lease agreements, utility bills. The bank is going to determine what documentation they're going to want to see. If we remember, the bill says 75% of the money must have been used for payroll, 25% for other expenses. They would want documentation of that you paid those other expenses. They would want documentation that you used the other 75% for payroll. Now, you must rehire by June 30th. We saw some of this in the original PPP bill, but it's changed. So that date's coming up pretty quick, guys. Okay, if you think about it, we're less than a month away from that being the case. So that if an employee was fired for cause, voluntarily resigned, or voluntarily requested reduced hours due to the coronavirus, that the borrower can still request forgiveness for the amount of payroll for that employee. But you must document the scenario in writing to give to your lender with the forgiveness application. And if an employee rejects an offer for rehire, the correspondence must be documented as well. So bottom line is, in the original bill, we saw that, you've got to rehire before June 30th, whoever you laid off. You need to be at 100% of the same amount of employees and at the same status, full-time versus part-time, that you were when you actually got the loan. And that was a gray area too, because it changed a couple times. So you had to have the same people when you got the loan as you do by June 30th. You couldn't get the money and then lay people off. And they're giving you till June 30th to be able to actually do that. The bill came up with some of these other scenarios where, somebody quits, for example, he resigns, etc. That's not the case. You didn't let him go. So they allow for some of that too, but you just have to document all of that as well. Now, if you don't have the same amount of full-time employees, as we know, the amount's going to be reduced. And it's going to be reduced by the same percentage of the reduction of your full-time employee or full-time equivalents. This is very big, guys. None of us knew this part. We just didn't know this. We guessed. So what happened was we said, okay, well, what happens if I don't maintain 100% of my current employees? What happens if I lay off 10% of my staff? What happens? I believed, and I said that what probably would happen is they would reduce the amount of forgiveness by that same percent. So if I laid off 10% of my full-time employees, then 10% of the loan would not be forgiven. If I laid off 50% of my full-time employees before June 30th and didn't hire them back, then 50% of the loan could not be forgiven. They've now verified that by the same percentage of the reduction of your full-time employees or full-time equivalents. So traditional loan SBA loans, though, consider a full-time employee of 32 hours. And with PPP, they consider a full-time employee to be 40 hours a week, bottom line. So somebody that's considered to be full-time has got to be working 40 hours a week per all of this. Now, an amount of wages reduced in excess of 25% per employee will not be forgiven. So what this means, and this 25% is a new number, is that we understand that you can't lay people off. And if you lay people off, the percentage of people you lay off is the equivalent of percentage of loan that won't be forgiven. They've also said that you must maintain the same amount of full-time versus part-time. You can't keep your current staff and then reduce them all to part-time. So this is new, and this new regulation says any amount of wages reduced in excess of 25% per employee will not be forgiven. Okay, so if you've reduced the wages of somebody by 25%, that's not going to be forgiven. So let me give you an example. Let's say I take a full-time employee and move them to part-time during all of this. Well, that money would not be forgiven for that employee. Now, if an employee earns less than $100,000, you can offset wage reductions with hazard pay and bonuses that are eligible for forgiveness. And the wage reduction applies only to the portion of the decline in employee salary and wages that is not attributable to the FTE reduction. The bottom line is is that reduction of 25% applies only to the portion of the decline in employee salary and wages. So what they're looking for is not overall in your company. What they're looking for is just, did you pay your people from full-time to part-time, for example? Did you reduce the amount of full-time employees that you have? Okay, so that way, they're trying to ultimately make sure that you're keeping the PP, that you got the PPP loan to actually maintain payroll. Now, that's a little bit confusing as well. Owner employees, which is you and I, right? And the self-employed payroll forgiveness is capped at $15,000. So what that means is that's the only amount of your own salary that gets paid that's actually going to be forgiven. If you pay yourself $10,000 a month, well, then 20,000 over the 8-week period, part of that's not going to be forgiven. You can't calculate that because your own salaries there won't be forgiven in that mix. But the maximum loan amount for a self-employed individual will be based on 100,000 annual compensation. We understand that. Remember, they would never even let us use more than $100,000. Those people got anything over 100 grand was never issued a loan to begin with. But this is the amount of money that you are able to actually get forgiven towards money that went to you. Okay. And with the 2.5% calculations required in the process, the loan will be higher than this amount. Well, I don't need to dive into that, but the bottom line is that they didn't let you count anything over 100 grand into the actual loan amount that you got initially. But this is a big change. $15,385,000 is all the money that you're able to pay yourself to actually get that amount forgiven. Okay, so that being said, that is what the Treasury bill has done. So now what we see as a response is about 5 days later, the House passed the Paycheck Protection Flexibility Act. Now, this has not passed the Senate yet. Okay, so from last time checking, this is not passed yet, but this is in the air to counter the Treasury. So the House saw what the Treasury was doing and said, we got to concrete some things here or we're going to have some problems. Now, this bill attempts to ease restrictions on small businesses as they're actually trying to get their PPP loan forgiven after seeing what the Treasury bill actually did. Okay, so what does this bill do? Well, it does a lot of things. It's interesting. Now, remember, this is not passed yet, but it's giving you an idea of some of the impending changes that could potentially happen if this thing got passed by the Senate, if there were no changes. So the bill reduces the amount of loan needed to be spent on payroll from 75% to 60%. That's a really big deal, guys. So it used to be that, you get 100% of the loan, 75% had to be on payroll, 25% had to be on other expenses. With this new potential bill, 60% needs to be on payroll. That's it. And 40% of it can be used on expenses. So that's a big change. So that increases the amount of other expenses you could use the PPP loan from 25% all the way up to 40%. But the expenses still stay the same. You could use it for rent, you can use it for mortgage payment, you can use utilities, but you can use it for interest on other loans. This was one of the things that they initially proposed was not in the PPP loan. Now they're coming back and saying, yes, you can use that for interest on other loans as well. Now, they were trying to get it done at 50-50 level. 50% of it needed to be used for payroll, but still 60% is way better than 75% for sure. Okay, now the bill would extend the window businesses have to use the funds from 8 weeks to 24 weeks. That's a huge freaking deal. Let me tell you the problem here. It's not funny, but I kind of thought it was crazy. So what happened in this world was that people started getting their PPP loans right away. Some of us did. And so then what happened was that you had a lot of people that the business was still shut down. So think about this. You're a restaurant. You got your money first part of May. You're in Florida. You can't even, or let's say you got your money the 15th of April. Well, what happens when you can't even open your doors until May 15th? Like 4 of the 8 weeks you have to pay back, you can't use it on payroll because everybody's like at home. Your restaurant's not even open. So this was a huge problem. People were getting their money and they couldn't use their money for payroll because their people were still gone. Like they couldn't open up. The states wouldn't even let them reopen. So the time is ticking that they have to use the money. They only have 8 weeks. And some businesses, like even in Florida, we're only at 50% capacity in a lot of restaurants, right? So even now, even all the workers can't come back. Like if you own a restaurant down here, only half of your workers can even come back. So the bottom line is 8 weeks was not enough because a lot of businesses are still shut down, or because they're not even allowed to open yet, or they're not allowed to open at full capacity. So they can't use their money for payroll because their people are all still furloughed while they're waiting to reopen. That was a massive problem. Well, this new bill changes it from 8 to 24 weeks. That makes a lot more sense. So now we've got like 6 months. That gives us time to get through all of this, to get back to a point where these businesses are open, and gives them a fair chance to actually use that money for payroll. So if you tie these two together, this makes a lot of sense here. Let's say I'm a restaurant, right? Let's say I'm closed down for the 2 months. Well, I still need to pay my rent. I still have to pay my expenses. So by reducing it from 75 to 60%, it gives me the money that I need to use on expenses that I still have to pay even when my shop is shut down. But then it doesn't force me to use it on payroll, which I can't use when my actual restaurant's shut down. So if you tie these two together, it really does make a lot of sense. The second thing they did was they extended the pushback to rehire workers to December 31st, 2020. Again, an absolute necessity. You can't make everybody hire everybody back by June 30th when a lot of businesses are still shut down. Okay, I mean, my YMCA pool's not even open. Like half the stuff at the YMCA is still shut down. Our restaurants are still at half the capacity. So how can I hire back my employee levels to full time by the end of this month when I'm not even allowed to open my business by the end of this month? That's impossible. It's absolutely impossible to do. So now they're pushing that to December 30th. Remember, these are not the new fixed guidelines. The second part of this presentation is about what the House has passed, but we're still waiting to see what the Senate's going to change. This bill provides more leeway on loan forgiveness for business owners. Okay, and you get it. What this allows us to do is make it through the crisis and then be able to use the money like it's actually intended, which the current bill just doesn't allow us to do. So the business is intended to take small business owners out of an untenable position where they basically are now, right? Because they had to pay workers even when those workers aren't paying. Yet expenses like rent were ongoing. And so it's exactly as I explained. It just makes a bunch of sense. So is this thing going to pass the Senate? Well, so far it looks pretty good. Minority leader endorses the House bill, wants to push forward. Senator Marco Rubio, I love you, Marco, chairman of the Senate Small Business and Entrepreneurship Committee, he supports a different bill. Let me tell you why this is important. Many don't know that Marco was the one that put PPP loan together. It was him. He's the chairman of the Senate Small Business and Entrepreneurship Committee. So it was Marco that put the actual bill together with PPP. I know this because I know a lot of people that were talking to Marco when the actual bill was getting passed. And this is like in the last minute where they were adding people in and saying, okay, if you have multiple locations, you can still qualify for multiple loans. And all these last minute changes were all these lobbyists trying to lobby Rubio to try to get Rubio to make all kinds of changes. He was the one, his group is the one that put the PPP loan together. That's why that statement is very important, that he supports a different bill. He doesn't support this bill. He supports a different bill. But the good news is that the bills are pretty close. What they're saying in their language is pretty close. So a compromise is very possible. And Rubio's approach would only extend the rehiring deadline to 16 weeks instead of 24. So that's an example of the change. It's pretty close, but Rubio, for example, would give you 4 months to get those people back to full capacity versus actually 24. And he also opposes the House bills easing on forgiveness without rehiring workers. So again, Rubio really wants to force you guys to rehire those workers to have that amount forgiven. So there's some differences there. Okay, now that's pretty much it. I want to wrap up with that. Now, what I'm showing our clients is, hey, don't forget, let's not get caught up on that. There's still the credit line hybrid. There's still other funding available out there. So don't forget to talk to your clients about this program. The up to $150,000 of finance, 0% rates for up to 18 months, helps them build business credit, good credit required. To get the business cards, they're going to need about a 680 FICO score. And don't forget to talk to your borrowers about business credit as well, because there's a lot of things that business credit can help them do. Look, I don't know about you and your primary business if you're not offering business credit financing as your primary business, but I can tell you that we're slammed. I can tell you that our partners are slammed right now. You are in a very good position being a partner with Credit Suite. And I can say that because this is what happened in the world today. This is just to catch you up to speed with the funding world. I'm not talking about the world. You know what's going on there. We all see that. But when it comes to the funding world, here's what happened. Cash flow, credit, collateral, the 3 C's, right? Well, cash flow financing almost just evaporated overnight, because think about it, right? I mean, to get money based on consistent cash flow doesn't exist. Almost every business, not every business, but the mass majority of businesses saw dramatic reductions of revenue. So cash flow financing kind of was ceased because so many businesses stopped overnight producing revenue. That brings you to collateral-based products, inventory financing, equipment financing, 401k, stocks, bonds, IRAs. Look, we've helped over 40,000 people get money. And I can tell you that way less than 5% of them have any of those kind of assets. So even though I can tell you about, 401k and stocks, bonds, IRAs, equipment, inventory, book of business, account receivables, purchase orders, I can go on and on and on about all the asset-based funding products that are out there. Those very few people have the assets to be able to get collateral-based financing. They don't even own those assets. So that accounted for less than 5% of any client we ever talked to before in the past. So 95% of people don't have collateral. Now cash flow financing is shut down. That leaves just about the only funding option that's even feasible to be this one, the credit-based financing product. The problem here is that all credit card issuers started immediately, not immediately, but soon after, started declining all borrowers. Now, the credit line hybrid program is still solid because in order for this program to work, the funding sources had relationships with underwriters at the major banks, just like Credit Suite has relationships with, with Amazon and with Walmart and with all of the people in our finance suite. We know their underwriters. We talk to their underwriters. It's how we get their guidelines in our back office. Well, that's what they do with Bank of America. It's what they do with Chase. It's what they do with all of those other sources. So they're getting these loans, these credit cards and credit lines still approved, but they're doing it from inside connections, which takes a lot more time to get it done. And on top of that, the credit card sources like Bank of America and Chase used to pay affiliate commissions to the funding sources that got it done. So let's say, for example, we use Seek Capital as a funding source. Well, Seek used to get paid back in affiliate commissions from all the credit cards that they get our clients. We don't see any money of that. You don't see any money of that, but it does exist, and they are getting those affiliate commissions. But now they're not. Overnight, every one of those sources stopped. So now the funding sources with this product are getting way less money because they're not getting those back-end affiliate commissions, and they're spending a lot more time underwriting the file because now they're getting no automated approvals. All approvals require this long hold time to talk to their underwriters at the banks. So they're committing a lot more time and making less money. You get that that's a bad combination. Your expenses go up and your income goes down and your margins get slim, so it gets tough. So the funding space is in disarray. You've got the main product here. We're still crushing it with this because we've got a source that we do so much volume with that they're still holding true. They're still keeping our payments the same. Everything is good there. But the other funding sources we worked with in the space have been decimated. They worked great in an office. Now they're working from home. They're having all kinds of problems. Their customers are upset. There's a lot of issues here. And that's why we've had to strategically find the sources that are better, but a lot of them are struggling with this product. Then we talk about cash flow financing. It's basically on hold. SBA loans are basically on hold because of PPP loans. Most people don't have collateral, so you see what's happening. You're creating this world where there's not a lot of other funding options left. But guess what? We're still seeing store credit cards backed by the major stores still approved at the same level. We're not seeing any of that change. We're still seeing vendor credit issued like it always was. We're still seeing store credit issued like it always was. Because guess what? They're busy. Walmart's busy. They're giving away their second round of bonuses. Amazon is, Amazon's busy. It's to a point where they now expect Jeff Bezos within the next 1 to 2 years to be the first trillionaire. that ever existed. So I mean, the credit, the retailers, a lot of them are doing pretty well. So they're still issuing business credit. And what happened, it's just so crazy, is that it all comes down to you and I being in the right place at the right time, which is a good place to be. I was a mortgage broker when the mortgage crisis occurred. Wrong place, wrong time, front lines, disaster. I sit here now and go, wow, this is a change. We're in the right place in the right time. People love what we have and need it more than ever because they're not able to get financing. And so as a result of that, our partners are slammed. A lot of our partners that sell consistently are selling at a higher level. Credit Suite is exactly the same. Last month was, I think, our third or fourth highest volume sales month that we've ever had in the history of the company. And we've been around since 2015. So this is our 5th year in business. And it was our 3rd or 4th best month we've ever had. So I'm just saying this, because you're in a good place. You have a product that people desperately need now because the funding industry's been so decimated. Business credit goes to the forefront now of the major way to get money, while a lot of our competitors no longer exist. A lot of the people that were trying to compete against us in any kind of lending space are now gone. So it really positions you very, very, very well. Something to really think about here is business credit's a great solution because people are still able to get business credit like they could before. The importance of building your fundability to get financing is more important than ever before as well. And at the same time, a lot of the business lending products that other people could get, they no longer can get, which again makes it harder to get that funding. Another reason business credit building is so important, and another way to get money when they can't get money other ways. So I'm going to wrap this up. I want to answer any questions you guys have. Sorry for no, this question just came in a few minutes ago. Ty, now the credit line hybrid is requirement 60. I put that on here, and then I kind of tried to hide it. And here's why. It always was 650 in the past. To get consumer cards, you need about 680 to 700 to get the business reported cards, but it really is 680 now. My apology for having that 650 on the slide. It's changed now. They really want you to have 680 FICO to have any chance of credit line hybrid because the credit card issuers have tightened up. So at 650, we're not going to get much approved, and they're only going to be limited consumer cards if we did. But 680 is really the major requirement to get this program or to get much funding with this program, especially with business cards, Ivan. Hopefully that answers your question. Leo says, quick question about the disaster loan program. If a company has an EED tax lien, will the SBA still approve the loans? The EIDL requirements, from what I saw, is you just couldn't have defaulted on another government loan. Hopefully that answers your question. So if you ever defaulted on a government loan before, then you can't get an EIDL. If you didn't default on a government loan before, you should still be okay. That's how the guideline actually read, Leo. So hopefully that answers your questions there. So I'm going to wrap this up. This isn't going to be an hour. I didn't mean for it to be an hour. I want to give you an update of what's going on in the industry, which we've done, the importance of business credit, talk about all the changes that's going to happen with forgiveness, of what's already happened with the Treasury bill, of what it looks like may happen with the new bills, to give you guys some information to be able to share with your audiences. And I'm going to make this available for you as soon as the playback's available, as soon as tomorrow. I'll make sure that this PowerPoint's available. As you know, you'll have to make some changes here because our information is all over it. It's not ready to go to the back office. And that's the way I am with everything, is that if we put something in the back office, we make it customizable for you. We remove all of our stuff. But if I just give you a download that comes with a webinar like this, I'm not going to take all the time to do that, because by the time I take the time to do that, it's not going to be of use for you. Your window of opportunity will have passed. So you still need to make some changes on that. Okay, and Leo says, about the hybrid, having EED tax lien is an issue. It's not if it doesn't report on the credit report. The credit line hybrid you can still get with any kind of lien, but if an actual judgment or anything like that is on the credit report, that's where it's a problem. If not, it's not an issue. Jefferson says, have a client being reviewed. FO is asking him to sign a limited power of attorney. Is that normal? The FO is not. Our team would never have any of your customers sign a limited power of attorney. That does not happen. We would never ask for that. But what you're asking about isn't us, Jefferson. You're asking about this program, the credit line hybrid. The way the credit line hybrid program works, we send to a funding source. The funding source will then have the customer sign a limited power of attorney, giving them the ability to apply for credit on their behalf. The funding source will then go in to secure 5 to 8 different credit lines on the customer's behalf, up to 150,000 in funding, no doc, 0% rates for up to 18 months. The customer has the ability to take cash out. So our team would never ask you for that. But yes, that is the norm with this product. It has to be done because the funding source is the one applying for those credit cards on the customer's behalf. And there's nothing sketchy going on. I referred to Seek Capital before, as an example. They all have relationships with the lenders. The lenders know what they're doing, know who they are, and that's how they're getting these deals approved. They're calling the underwriters of the lenders and using their leverage to get them done. So nothing sketchy. The credit card issuers know that they're applying on the customer's behalf and actually like it that way, but the person has to sign that limited power of attorney, giving the funding source the ability to go apply for the credit cards on their behalf. So yeah, very normal. And Jefferson says no more soft pulls on credit. Yes, the funding source does do a soft pull on the credit, but when they go to actually get the cards, there's always hard inquiries. That's never changed. So what will happen is you send the customer into us, to the finance team. We find the best funding source, right? Then we send them to that funding source. And at that point, the funding source will give them a pre-approval, typically same day. Here's how much money you can get approved for. For that to happen, they do a soft pull and there's no inquiry. So for a customer to find out what they're pre-approved for, there's never an inquiry. But the minute they actually sign the power of attorney, sign the documents and say, yes, I want this program, go get it for me. When they go to apply to get those credit lines, that's when inquiries show on the credit report. So the inquiries only happen when the customer signs and says, move forward, I want the funding, and that's explained to them, but there's no inquiry until that happens. Up until that point, it's only a soft inquiry. So I'm going to go ahead and wrap this up. Everybody, if you have any other questions, please type them in and let me know. Otherwise, I am going to get this PowerPoint over to our team to make it available with the download. You can go to your back office, go to training webinars. This is available, and it's available on the homepage as well. When you go to training webinars tomorrow, you'll be able to see this is the most recent one, and you'll be able to download this PowerPoint as well. If you have any other questions, just reach out to us, of course, at support@creditsuite.com, or you can go to contact us at the top right of your back end of your back office. And at that point, you can easily then get in touch with our team through email, through chat as well. So I'm going to wrap this up. Hopefully this provides value to you guys. If you have any other questions, please let us know. Thanks, everybody. Have a great day.